example, and this will be with the breakup structure. First of all, we identify a bearish trend. So here we have a clear bearish market structure where we have a high in the market that went on to make a low. Then we mark out our points of interest. Therefore, in this case, we mark out the extreme. That is our supply zone that we are going to be looking to sell within. And price starts to do its bearish complex pullback, that retracement, which is healthy, which is normal, to arrive to our supply zone, that extreme we want to be trading within. We see along the way, we have built up liquidity. That is preferred. That is ideal because now we have something to induce into. So we'll get a build up of liquidity inducing into our supply zone. That would be the preference. Then price also builds liquidity on the downside, that target that I mentioned just a moment ago. So not only do we have the build up and inducement and mitigation into the entry, but once we have entered the trade, we have somewhere to shoot for. We have somewhere to target. That target can be this trend line liquidity. So what do we expect from here? We expect price to come higher, grab this liquidity over here and shoot into this supply zone. If it's happening in our key time window and we're getting our lower time frame confirmations, we can take this trade and make it pro trend to make a lower low, but along the way, we take this liquidity of this ascending trend line. So here we have it, price starts to come higher, shooting into that build-up area and grabbing that liquidity. So right now we are forming an inducement and arriving into our supply points. And as we are arriving, we are starting to get price to consolidate a little bit. What is it doing? It's rounding off. Notice how in the beginning it was coming really sharp and fast. Then it started to lose momentum. It started to compress. It started to slow down. What is that? That is price building up. That is price showing signs of weakness, maybe signs of reversal. And what are certain individuals going to do? They're going to see this and think, price is ready, let me get in. The market is showing people what they want to see, inviting them in and building up that liquidity. And this is step one of the liquidity cycle. We're building up right before our IFC over here, the refined IFC, that has the imbalance we want to use. So that's perfect. If we're getting a build up right below a point of interest and we see a refined IFC with an imbalance, this is just waiting for that inducement. Next step, we do get that inducement. So now we have checked everything we needed to see. We've had alignment of trend. We've got a bearish market. We've got a supply point that has a refined IFC. That is confirmed with the imbalance and follow through with the breakup structure. Price starts to do a complex pullback and it does a build up on a higher time frame. It also has a liquidity target right here to be trading towards. And then as we are arriving into our area of interest, price starts to slow down, consolidate, do a build up, then we get an inducement to take out that liquidity, and that inducement does a mitigation. It closes that imbalance. Now we are getting a strong sign of our liquidity trap model. All we need now is a breakup structure to confirm it, and that will be our best entry we can take. And that's what we see here. We see price do the inducement, it comes higher, it mitigates that supply zone, and then that last higher low that made the higher high, it goes on and makes a lower low. It gives that breakup structure. The bigger the displacement, the bigger the breakup structure, the more confirmed it is. Obviously, we don't want price to come all the way down. That's too far. The trade's already gone. But if we can get a clear breakup structure, taking out a previous higher low that made the higher high, and then we get a strong push down, forming a lower low, that is that confirmation we need. And as you can see, this is one of our variations on the diagram where we get a build-up, inducement, mitigation, and breakup structure, and then we just find our refined IFC, that imbalance that we are going to be taking that trade on. We set that sell limit on the close of the imbalance and put the stop loss at the high on an M1 or M5 time frame. That usually should be that 3 to 10 pip stop loss range we should be utilizing. And then as you can see in this example, we had that inducement and mitigation, we had the breakup structure, then we came back to the imbalance, closed it, that would have triggered a sell limit, and then price continued lower, targeted that first trend line, then went lower again, targeted the next trend line, taking all of that liquidity and then going on to make a lower low alignment with the trend, which is where we began. And just to really make this point hit home, let's show you one last example. We have here once again a bearish market structure. We can see high, low, lower high, lower low. What do we do first? We identify the supply point. In this case, we're looking at the extreme. Now, if we are to focus on this extreme, we can see we have a refined IFC within it. You can see it has the refined IFC with that imbalance right there. So the point of interest is a preferred one. And not only that, it's a strong point of interest because we have the build up over here, run of liquidity that made the supply point and a breakup structure to confirm it. This, as you know, is our strongest point of interest type. It's an inducement that led to a breakup structure. That is the best point of interest, confirmed with an imbalance. Perfect. Then what we do is mark it out, mark out the imbalance, and then we allow price to come back to it. After we've had the lower low in the market, we allow price to come back up, climb slowly, and build liquidity for us. This liquidity point over here, we know that that can get induced because it is an area where people want to sell. Not only that, we have these trend lines forming that are targets for us. So once we are in the trade, we can start to target that liquidity. So everything we want so far looking great. As price goes into the supply zone, into our preferred area, and closes that imbalance, that's when we look for our lower time frame confirmations in our key time window. Let's see how that looks. Price goes in, but it does not give a breakup structure, so we cannot enter just yet. We wait, and then we zoom in and see, okay, we finally had that last inducement. We've had that last run of liquidity. We are in our preferred point of interest, the extreme. So we've had the build up, we've had the inducement, it's in our key time window. What do we need next? The follow through, the breakup structure. Once we get that qualification, we've had a breakup structure. What do? We find a refined IFC. We find that imbalance. We set our sell limit, stop loss at the high, and that becomes this liquidity trap model entry. As you can see, that's exactly what happened here. We targeted that purple box, which is that refined IFC. We had the breakup structure following through, targeting these liquidity pools, and in the end, going on to make a lower low. So what you've seen right now is our preferred entry type. It's a build up, inducement, breakup structure, mitigation, all happening on the 1 minute time frame in the correct area of interest at the correct time. This is our best trade setup type and our best low time frame confirmation type. If you're only to trade